horizontal drilling, you can develop these resources, and then go into co-development where you're completing all of these stack pays all in the same operational initiative, significantly reduce the cost. And so, the real savings in being able to do that is investing in the infrastructure like we have. And so, getting back to your original question, we believe we see opportunities up and down the Central Basin Platform in all of the areas that we currently operate. We are continuing to evaluate extensions from those areas, and we're leasing, and we're looking for more opportunities. We believe by the end of the year, our portfolio will be significantly higher in terms of the inventory for us to prove. So over the last couple of years, as you know, earlier on, we had a good medium-term development program of 5 to 10 years, and we've now gotten to the point where our inventory is over 10 years. We believe by the end of this year, in 2027, with the efforts of our geoscience teams and land teams, we believe that we'll significantly exceed that as well. Does that answer your question?
Yes, it does. Paul, I believe you started 2026 with a capital plan that was pinned on a $60 oil price deck, or in the low 60s. Can you share what you're pinning the 2027 plan on?
Yeah, so the 27 plan, as we're putting it together currently, will be a higher capital spending plan than we started at the beginning of this year. So let's go back to the beginning of the year. We had a modest capital program, and we were anticipating a price environment that was going to test even $50 oil. And so we spent a lot of time strengthening our floors, layering in hedges to strengthen the floor so we could guarantee we'd have at least $60 at the wellhead, because we believed we needed that to fund the development program to finish testing all of these ideas that you and I just discussed about the stack pay intervals up and down the Central Basin Platform. But looking at 2027, okay, let's go back up. When oil prices increased after the war with Iran initiated, and then also the equity raise, that positioned this company to strengthen the balance sheet strongly and then take advantage of the higher prices to start making these investments a little bit earlier in the infrastructure necessary to have the higher capital efficiency of these longer laterals and co-developed locations. And so we're really excited about that. But the capital spending levels next year are going to be pretty much in line with what we've done in the past. Typically, this company has had a $150 million plus or minus type annual capital budget. Next year, we're planning to spend a little bit more than that, 158 to 100 or so, 160 type million dollars. But we believe that because of the added capital efficiency, we will end up delivering more barrels a day of production and more barrels of reserves per dollar spent as a result of the investments we're making this year. And it's going to make for significant production growth that is basically organic production growth that we have not delivered in the 5 years or 6 years that I've been here. So we are positioning the company for accelerated production growth, which means, depending on prices, accelerated EBITDA growth. And this also is setting the stage for even potentially a stronger 2028.
Thank you.
Yeah, Jeff, and I can just add a little more color to that, just to give you a little more definitive answer. We're running $75 in the near term for this next quarter, and then we've stress tested our development program going into 27. And even taking it down to a $60 oil price in 27, the economics still work, and we're able to marginally generate free cash flow.
Thanks, Sanu.
The next question comes from Poe Fratt of Alliance Global Partners. Please go ahead.
Hey, good morning.
Hey, good morning, Poe.
Hey, congrats on the offering. There clearly was an impact on your CapEx. Can you potentially talk about whether there's going to be less limits on your, on how much you hedge going forward. You've in the past highlighted that the bank's revolver has sort of limited your ability to capture higher prices. Going forward, are you going to be in a better position to capture the upside if commodity prices are higher?
Yeah, that's a complex question. I think we should probably just go back and start, just kind of lay the framework to address what does our credit facility require. So our credit facility requires that we hedge 50% of our oil and natural gas production for the first 24 months. During the time period where our leverage ratio is above 1.25 times and the draw against our borrowing base is greater than 50%. And so you may have seen in our press release and also in what we just discussed that we are very specifically focused on getting our leverage ratio down below 1.25 times. Because then at that point, as long as our draw against the borrowing base is less than 50% of our borrowing base, then 50% of the longer term hedges, so months 13 through 24, they fall by 50%. We believe that is a key. If you go back and analyze the hedges over the last 5 or 6 years, the majority of the losses associated with those hedges were associated with those longer term hedges that we put out in place during months 13 through 24. And so to the degree that we can lessen that, we will. And so, and then what that does allow, though, it allows you to move more towards an opportunistic hedging strategy, because we really do believe, strongly believe, that we like to hedge our capital program each year to make sure that we have a protected position that protects that capital program, because the capital program is what delivers the EBITDA and also positions the company for sustainable growth in the future. And so if you look at our hedge position today, right now, during the third quarter and fourth quarter of 26, we're hovering around 30% of our oil production exposed to higher prices. But when you move into the second or the first half of 27 and the second half of 27, now we're talking about 60, 61, 63, 64% of our anticipated and forward-looking production being exposed to higher prices. All of this is summarized on page 20 in our investor deck, but it does demonstrate, real meaningful upside to adjusted free cash flow for the company. Does that answer your question, Poe?
It did. I guess the short answer, Paul, is that, the offering helped, but it didn't get you to where, the hedging program's going to be less of a constraint. You're still going to have to grow production, capture higher prices, and then hopefully, you'll be at that point where the hedging program won't limit your upside as much as it has in the past.
Yeah, and so one of the points, Poe, that I think I should also throw in, if you look at what these prices are doing to our trailing 12-month EBITDA, which is a component of that leverage ratio calculation, see, we are rapidly dropping our leverage ratio. We anticipate being in a position to qualify for each hedging requirements in months 13 through 24 by as early as first quarter next year. Wouldn't you say that, so, Sinu?
Yeah, it's all price dependent with the volatility. So,
right.
Yeah, but we're with this elevated program, does put us in a much better position with the banks in our leverage ratio.
Great, that's helpful. Thank you.
Yeah.
Good.
Are there more questions?
The next question comes from Noel Parks of Tuohy Brothers. Please go ahead.
Hi, good morning. You're talking about your continued leasing program you're looking at doing for the horizontal plays. You're sort of saying in looking at many areas of the Central Basin Platform. And I'm just curious, now that you have sort of like the runway for the horizontal play, and you have a shot at some potentially compelling economics there. When it comes to sort of the land operation, does sort of that simplify what you can pay in bonuses in a given area, or does that sort of complicate the whole land equation as you look to develop horizontally?
No, I mean, it doesn't complicate things. It's pretty much the same type of business. The real challenge is finding the opportunities in an area like the Central Basin Platform that is so mature, and most of that acreage out there is held by others. There are areas, in our opinion, that have been overlooked, even in the historical development of the Central Basin Platform, because even though some of these identified pay zones that do retain and hold hydrocarbons, historically the porosities and permeabilities were so low, and the technology back then was what it was. Nobody ever really leased the lands and pursued it. And so we do believe that the Central Basin Platform still has a tremendous amount of opportunity. If you go look at page 10 in our investor deck, we've pointed this out in the past. You can see how more developed the Delaware and Midland basins are from a standpoint of ownership of larger, organization, public companies, and a lot fewer privates. Well, the Central Basin Platform and the southern part of the Northwest Shelf have a lot more opportunity. And even those lands and producing acreages that are owned by the larger companies in the Central Basin Platform are still not core to them, and they've demonstrated a willingness to sell. And so we believe there's more opportunity in the Central Basin Platform, the Southern Shelf, to grow than what Little Ring can probably pursue all on its own. And so I'm not going to say we have infinite growth capacity, but at this point we have not seen the end to our potential, and we're very excited about that. We have allocated more money to land acquisitions this year. We are not pointing out where we're buying land because we just don't want to have the increased competition. It is already an area of significant competition anyway. But we are making progress, and I cannot wait to disclose the progress as we progress throughout the year.
Great, thanks. And I just wanted to take a minute to get your thoughts on crude oil macro and sort of what your current theory of the case is as far as why we don't have more strength in say the 2027 strip and beyond, considering that the months tick by and it still doesn't look like there's really a definitive sort of resolution to what's going on with Iran.
Yeah, so Noel, there's a lot about what goes on in those open markets and what influences future prices that just I'm not qualified to even address. But I do have an opinion that forward strip does not reflect the fundamentals going on right now. So if you just look at the amount of production that has been curtailed just through the Strait of Hormuz. Now, we found alternative routes for oil to come out of there. That has helped. But if it wasn't for the strategic petroleum reserves scattered around the world, not just the United States, but other peoples as well, we would have been in a lot worse shape than we currently are. So we also had the benefit of a lot of floating and onshore storage that, if you remember before the war, that was the justification for why we really thought that oil prices could go below $50. Well, now all of that storage has been consumed, and all of the storage worldwide. I mean, I think there was an article just yesterday about the Strategic Petroleum Reserve, earlier, maybe last week, about the perilous level that our current Strategic Petroleum Reserve is at, requiring infrastructure repair there and a few other things before it can be fully utilized. And so we're probably talking about, just from a standpoint of meeting demand, the Strategic Petroleum Reserve still has more to pump out based on the last order that our president gave. But that's gonna be gone in probably a month. and hopefully the Strait of Hormuz will be resolved by then. But the reason why I believe there's going to be additional pressure is because not only will the world decide to refill the strategic petroleum reserves that we've depleted, because that's just the rational thing to do, but we've now read that several countries around the world have now decided to either build a strategic petroleum reserve for themselves as a result of this disruption, and others have said that they're going to expand the ones that they have. And so all of that is going to be in addition to the demand that we've seen. And if you go back and look at the emerging economies around the world, there are countries now with large populations that are now seeing explosive, growth in their middle class. And so what happens? Those middle class individuals that are going to want to have the same lifestyles that the rest of the world has enjoyed. And so I just don't see a reduction in the historical demand for oil that we've seen. And all I see are additional fundamentals that are saying that we're going to need more oil in several different ways. Now, of course, we are becoming more and more efficient. Our automobiles are using less gasoline or whatever, getting better fuel mileage. There's a switch to EVs. I don't think that the switch to EVs is going to have as big of an impact as many people have said. But I also see demands on the natural gas side to generate the energy that these data centers are going to require. So everywhere I look, I see the fundamentals point to higher demand. And for the last, in my opinion, since the last big oil price shock the world saw back in 2028, and then the one before that, after that in 2014, I mean, the world has not been investing. So we've been relying on the spare capacity of all of the world's supplies, and we haven't been investing at a rate necessary to replace the decline. And so there's going to be a point in time, and I believe this disruption that we've seen with the Iran war may have accelerated the crossing of the world's ability to deliver oil versus the world's demand for oil. And we don't know that. That's something that is harder to discern, and it comes out over months of data. But I believe we're approaching that, and if something doesn't change soon. And so I've even mentioned in the past, at least with my guys and with others, a good $80, $85 strip price that's flat would incentivize the capital investments that the world needs to start making investments now, so that we never do cross lines where the demand actually exceeds our ability to deliver. But if we don't, I believe in the next year or two, we're going to see those lines cross of supply and demand. And it takes years to build the supply. And so we'll see how things go. But, I'm a firm believer that as we go into 27 and 28, the likelihood of seeing $50 or $60 oil becomes less. I'm not saying that we won't see it because, we have stranger things happen in commodity markets. But, the basic fundamentals right now to me appear to be strong going into 27 and 28. And we want to make sure that we position Ring Energy so that we can deliver the organic growth to take advantage of what I believe will be a stronger market environment.
Great. Thanks a lot. There were a couple points in there I hadn't had on my radar screen, so appreciate it. Thanks a lot.
You're welcome.
Our next question comes from Jeff Robertson of Water Tower Research. Please go ahead.
Thank you, Paul. Just to come back to the asset base, with respect to the horizontal wells that you have in the second half plan for this year and next year, is the lateral length being dictated by the shape of the geometry of the leases, or are there other reservoir issues that are helping determine the optimal lateral lengths?
Yeah, in most of our areas, the lateral length will be dictated by the units and the land position. In the last 2 years, we have been focusing our land acquisition efforts to ensure that we can unitize and develop these longer laterals. And so that's been a trend that we've been saying we wanted to do, a year and a half, almost 2 years back. And that's the primary driver in that regard. Now, in the South, where we have historically drilled the inexpensive verticals and applied multi-stage fracking to these verticals, drill them and then drill them all out and bring them all on. In those areas, there are still areas that will prevent us from drilling the longer laterals because of the way the units are developed and all that. That's a little bit of work that the land department needs to dive into, and there are solutions to that. Our goal, though, is to convert all of our units to the extent that we can so that we can drill these longer laterals and take advantage of the increased capital efficiency. So when you can reduce your lateral cost by $50 to $100 a foot by pursuing this technology and drilling the longer laterals, it's just a smart thing to do.
Thank you.
Jeff, if I may, I'd like to add something to that Paul covered. On slide 19, we actually, one of the big things we're doing now and why we updated the guidance, and our new guidance actually shows that we're going to drill longer laterals, is also the infrastructure dollars that we've been spending, right? Building the facilities, the frac pits, and then also getting enough disposal for these longer laterals obviously bring on more production and also water. And so we needed the infrastructure dollars to be able to drill the 1.5 and 2 mile wells in the South. So that's the other reason.
Thanks, Alex.
The next question comes from Poe Fratt of Alliance Global Partners. Please go ahead.
Yeah. Paul, you mentioned asset sales in your prepared comments. How much could you generate from asset sales, and any idea of the timing of those sales?
Yeah, that's a challenging question to answer. I don't think there is a right answer to that. Some of the ideas we have are in their infancy stages. In other words, we're looking at what other people are doing. Some people have approached us saying, "Hey, we really like this or that," and so those thoughts or those processes haven't moved very far along. So it's kind of hard for me to come up with a number. There are other initiatives that we're looking at that are probably a little bit farther along, but I think it's premature to talk about how much money we think we can raise. But if you just look at our history, so since I've been here with Ring, and I'm approaching 6 years now, we have continued to optimize our portfolio. We've made acquisitions in the past, and we found that in those acquisitions there were assets that did not fit our criteria, and so we were careful to spin them off. For a whole bunch of reasons, we made the decision to exit our position in New Mexico and other assets. And so this is something that we routinely do. And the reason why we mention it again is because we want to remind our shareholders that this is still another avenue to help strengthen the balance sheet and put the assets that we don't value as much into the hands of people that value them more, who are willing to pay us the premiums for them. And so we're going to continue to do that. And we'll probably never stop doing that, to be honest with you. But today and at this point right now, to give you a range, I think I'd be way out of line. I think my CFO might yank a knot in my tail if I were to come out here and say too much.
Appreciate it, Paul.
Sorry to not answer your question, Poe.
No, that's all right.
This concludes our question and answer session. I would like to turn the conference back over to Mr. Paul McKinney for any closing remarks.
Thank you, operator. And on behalf of the entire team and board of directors, I want to once again thank everyone for listening and participating in today's call. We are pleased to have posted solid operational and financial results for the second quarter of 2026, and our outlook for the remainder of the year remains solid. We will continue to keep everyone appraised of our progress, and thank you again for your interest in Ring Energy. Have a great day.
The conference is now concluded. Thank you for attending today's presentation. You may now disconnect.